In the year 2000, the average commission to trade a single stock was nearly $30. Today, for almost every major brokerage, it is zero. This has been celebrated as the great democratization of finance. But here is the truth the industry prefers you do not know. Free is rarely free. The most significant costs of investing are now hidden in ancillary fees, in the interest rate you're paid on your cash, and most insidiously in the behavioral traps designed by the platform itself. The wrong free broker can cost you a fortune. In the next 10 minutes, you will learn the 5 critical factors you must analyze to choose the right brokerage account for your needs. We will cut through the marketing jargon and give you a clear, objective framework to select the platform that will serve as the foundation for your entire investment portfolio. A brokerage account is simply a specialized financial account that gives you the ability to buy and sell securities, assets like stocks, bonds, and exchange-traded funds, ETFs. The brokerage firm acts as the licensed intermediary, the secure gateway that connects you to the world's financial markets, like the New York Stock Exchange and the Nasdaq. Before you can choose the right gateway, you must first understand your journey. Broadly speaking, there are 2 types of investors, and the best broker for one is often a terrible choice for the other. The passive investor. Your philosophy is long-term, buy and hold investing. Your goal is to systematically build a diversified portfolio, likely using low-cost index funds and ETFs. You transact infrequently. Your primary needs are rock-bottom costs and a simple, intuitive platform that stays out of your way. The active investor, or trader. Your philosophy involves frequent trading of individual stocks, options, or other complex instruments. Your goal is to capitalize on short to medium-term market movements. Your primary needs are a powerful suite of research tools, lightning-fast trade execution, and access to a wide universe of complex securities. Identifying your investor DNA is the first step. But how do you objectively compare the dozens of brokers all vying for your capital? We've distilled the process down to a 5-point inspection. What is the first, and often most misunderstood, factor you must analyze? This is the 5-point inspection that will allow you to analyze any brokerage like a professional. Theory. The 5 critical factors. Costs and fees. The $0 trade commission is now standard. You must look deeper. Scrutinize the fee schedule for account maintenance fees, inactivity fees, and transfer fees. Most importantly, if you plan to use mutual funds, check the expense ratios of the funds they offer. Investment selection. Does the broker provide access to the entire universe of assets you need? While most offer US stocks and ETFs, you may need access to international markets, individual bonds, options contracts, or specific low-cost mutual funds. Ensure their shelf is stocked with what you plan to buy. Platform and tools. Is the platform designed to encourage disciplined, long-term investing? Or is it a gamified interface designed to promote hyperactive trading? Does it offer the high-quality research and analytical tools you need? Or is it a stripped-down, mobile-only application? Cash management. What interest rate or yield does the brokerage pay on your uninvested cash sitting in the account? This is one of the most important and overlooked factors, and we will return to it. Safety and insurance. Is the brokerage a member of the Securities Investor Protection Corporation, SIPC, or your country's equivalent? In the US, SIPC protects the securities in your account for up to $500,000. In the rare event of broker failure, this is non-negotiable. Analogy: choosing your vehicle. Choosing a broker is like choosing a vehicle. The right choice depends entirely on your mission. The passive investor needs a reliable, low-maintenance sedan. Their priorities are excellent fuel economy, low fees, an uncluttered and easy-to-use dashboard, a simple user interface, and the highest possible safety ratings, insurance and security. They have no need for a screaming V12 engine or a complex performance tuning system. For them, brokers like Vanguard, Fidelity, and Charles Schwab are the traditional gold standard. The active trader needs a Formula One race car. Their priorities are a powerful engine, fast trade execution, an advanced telemetry dashboard, sophisticated charting and analysis tools, and the ability to handle any track in the world. Note, global market access. They are willing to accept complexity in exchange for performance. For them, a broker like Interactive Brokers is the professional's choice. This framework makes it clear that the best broker is a meaningless concept. The only thing that matters is the best broker for you. Before we reveal the single most important factor for advanced investors, we must address two common traps that cost beginners dearly. Pitfall number 1: chasing sign-up bonuses. Brokerages often offer a few $100s or a handful of free stocks to entice new customers. Choosing a long-term financial partner based on a trivial, one-time bonus is a classic rookie mistake. The long-term costs of a suboptimal broker in the form of higher fees or poor execution will dwarf any initial incentive. Pitfall number 2: the gamification trap. Many modern app-based brokers are designed not as investing platforms, but as engagement engines. They use techniques borrowed from video games and social media, digital confetti, push notifications, and lists of trending stocks to encourage frequent, impulsive trading. This activity is what generates profit for the broker, often at the direct expense of your long-term returns. Avoiding these traps is about understanding the broker's business model. But there is one final crucial factor that separates the good brokers from the great ones, a feature that can save you thousands of dollars over your lifetime. The advanced strategy: scrutinize the cash sweep. The most sophisticated way to analyze a broker is to investigate how they handle your uninvested cash. The dirty secret of the brokerage industry is that many of the largest firms automatically sweep your uninvested cash into a default account that pays a pathetically low interest rate, often near zero. They then take your cash, lend it out to other institutions, or put it in high-yield government bonds and pocket the difference. It is a massive, hidden profit center for them and a direct cost to you. A top-tier brokerage in 2025 does the opposite. They will either automatically sweep your uninvested cash into a high-yield money market fund that pays a competitive interest rate, often close to the federal funds rate, or offer a high-yield savings account seamlessly integrated into the platform, allowing you to easily move your cash to earn a high return. The difference is not trivial. For an investor who keeps a $25,000 cash position ready for opportunities, the difference between a 0.1% yield and a 4.5% yield is over $1,000 per year. For an intelligent investor, demanding a competitive yield on your cash is a non-negotiable feature of a high-quality brokerage. Let's distill this into the 3 essential principles of choosing a brokerage account. Free is a marketing tactic. The era of the $0 trade commission has not eliminated costs, it has merely hidden them. The true costs lie in ancillary fees, poor interest rates on cash, and the behavioral traps of the platform itself. Match the broker to your strategy. First, identify your investor archetype. Are you a long-term passive investor who needs simplicity and low costs, or a hands-on active trader who needs powerful tools? Choose the platform that is engineered for your specific mission. Follow the cash. Evaluate all brokers on the 5-point inspection: costs, selection, platform, safety, and critically, cash management. The advanced strategy is to demand a competitive interest rate on your uninvested cash, as this is one of the largest and most overlooked sources of hidden fees. Your brokerage account is the single most important tool in your wealth-building arsenal. Choose it wisely. If this analysis provided you with real value, invest a single click in the subscribe button to get daily access to the Codex. Knowledge is the new capital. We'll see you tomorrow.